Hi, good afternoon. Welcome to the marketplace. Coming up, Ghana's disinflation continues, but rising global oil prices threaten stability. How significant could this impact be? We will discuss ahead. Also coming up, rising Middle East conflict sparks fresh energy security concerns for Ghana. My name is Darryl Kwao. Details coming up. Thanks for being with us, everyone. Ghana's inflation rate has continued a steady decline, falling to 3.3% in February, reinforcing signs of macroeconomic stability. However, analysts warn that rising global oil prices and potential fuel price adjustments in March could slow the pace of disinflation in the months ahead. I'm joined on Zoom by Amanda Amable, who is an economic analyst with Data Bank Research. Good afternoon to you. Great to have you on the marketplace. So headline inflation has dropped significantly to 3.3%. What do you see as the most important factors behind the sharp decline over the past?
Okay, thank you, Darryl. Good afternoon to you and good afternoon to your viewers. Well, as you've seen, inflation has dropped significantly by sevenfold from February 2025 to 3.3 for February 2026. Largely, we can attribute this decline to the base effect, but two main factors stand out functionally, where we see food inflation doing most of the heavy lifting. We've seen a meaningful easing in food prices, supported by improved supply conditions and better price anchoring across stable categories on the market. And the second point is that we've seen a lot of stability when it comes to our currency, and this has greatly reduced the import cost pressures we've seen, which has shown up through a slower pass-off to goods on the markets and other tradable items on our markets, strongly anchoring the rates to where we are seeing now.
So food inflation has eased to 2.4%, while non-food inflation has slightly increased as well. What does this shift tell us about the price dynamics in the economy?
Yes, so from the data, we saw an slight uptick in non-food inflation. We saw it rise up to 4.4% year on year, as compared to the 3.9% we saw last month. And what this tells us is that food prices are easing fast. As I mentioned, it was mainly driven by improved supply dynamics and basically the exchange rate pass through. However, with non-food inflation, as it proves to be a bit sticky, I believe this was more influenced by more price pressures when it comes to service costs or some transport and utility costs across the economy.
Yeah, and there's already talk about fuel prices going up following what's happening in the Middle East. How could this impact on the disinflation trend?
Yes, so we know we are not living in a bubble. Whatever happens in foreign context also applies to us. So the risks that arise from the Middle East tensions is not something that we can ignore. The Middle East remains a global hub for oil supply. So whenever we see tensions escalate in that region, we tend to see much price disruptions when it comes to supply. Currently, the Strait of Hormuz is under some disruption due to the tensions, and that provides the Strait of Hormuz is the main source of oil, the main energy shipping routes for the world. And once this route comes under strain, it's going to push more risks to increase global crude prices on the market. As we see, we are expecting the price to cross the $100 per barrel threshold. And what it means for our economy in particular is that where we rely more on imported petroleum products, we will see these costs also being transferred onto our economy, which could then result in higher ex-pump fuel prices, which eventually will feed into transportation costs and ultimately back into inflation.
I'm sure not many people will be excited upon hearing that oil may cost $100 a barrel. I guess what the business community is also expecting to see is what the central bank could do with this low digits we are seeing, the 3.3%. How do you think this is going to affect the next policy rate decision by the MPC? How would it affect borrowing going forward?
Okay, thank you for the question. This is a major concern we see in our markets now, given where the inflation rates are hovering. And there's a growing case for a policy cut at the next meeting, as we've seen significant progress on inflation and generally broader easing conditions across the markets with regards to the financial conditions. Inflation is within the BOG's target band, and we also see a general decline in interest rates across the markets, particularly on the short end of the yield curve. We saw the reference rate also fall to 11%. And we believe all these things together could create room for the committee to deliver another cut. And what we see for this market is that it would result in improved borrowing conditions over time. We may not see lending rates fall as quickly as a regular individual may expect them to fall, but gradually we would see these translate into improved credit conditions and basically supports the private sector investments, business expansion, and overall economic activity.
Well, let's talk about the outlook for the coming month. There are some projecting it to go to around 3.5% to perhaps 3.8%. I'm talking about inflation. Should this be a cause for concern? What are you seeing on that side? Is it a normal process?
So not necessarily. It's not much concern. It's not a cause for so much concern. In fact, I would say it's more like a normal adjustment in the disinflation cycle we've seen. And what this means is that we are seeing a small fade off when it comes to the base effects. And a lot of, we also see some one-off cost adjustments also temporarily showing up, bringing the rates to the projection of the 3.5 to 3.8 range. Where these one-off cost adjustments could be from fuel prices, as I mentioned earlier, and utilities as well. So what will cause some concern or what will cause some worry would be when the increase is driven by some buckets across non-food and services. So when it's across board, then it will raise some cause for concern. But for it being driven by some few volatile items like the fuel, it's not going to be much cause for concern. So when we see it being generalized, then it will imply that we are gradually exiting the comfortable trend we are seeing now to some more higher levels.
All right. Great to have you on the marketplace, Amanda Mabler, who is an economic and fixed income analyst with Data Bank Research. Thank you for your time on the marketplace. We are taking a short break. When we come back, we'll turn attention to what is happening in the Middle East and its impact on Ghana's energy security. We'll be discussing that coming up. Don't go anywhere. And welcome back to the marketplace. Global oil prices are climbing again as conflict in the Middle East disrupts crude supplies to major importers. With Brent approaching $84 a barrel, industry players warn the situation could eventually pressure Ghana's fuel prices, highlighting the urgent need to prioritize energy security. Joining me on Zoom, chartered energy economist Ifaniel Osajiman to discuss this. Good afternoon to you, Ifaniel. So, how is the ongoing conflict in the Middle East affecting global oil supply and prices, and what trends are we currently seeing in the market?
Right. So thank you so much. So when it comes to the ongoing conflict in the Middle East, the one key area that we can talk about is going to be the Strait of Hormuz, which carries about 20% of the world's traded oil that we have. That is where 20% of the oil that is being traded passes. And so when tensions like this are happening and escalating in the region, obviously we are going to see a few changes in the market. And this is comes up normally by the geopolitical risk that is coming, and it's coming as a result of the risk premium which will be put on various petroleum products that are transported within the region. So as it stands now, due to the perceived risk of disruption due to shipping delays, infrastructure attacks, or any sanctions that are coming up, this is going to be pushing the prices upward, as we can currently see that Brent crude is even trading beyond the 80 dollars per barrel mark, reflecting the uncertainty that is happening in the region. Another trend that we can be able to observe is going to be on various refined products, such as diesel, that are always also transported in the same Strait of Hormuz, the same region. When these uncertainties are going on, various countries, it happens that the shipping routes become longer, causing delays in the deliveries of these oil or these refined products. Is going to impact on the insurance cost as well. Refineries are going to struggle as well, because now the supply that they are going to receive is not going to be steady as it's going to be. So when these happen, this trend actually affects about, it's summarized into 3 factors basically. So when these uncertainties are happening, there is a geopolitical risk premium that is added to the crude prices that are going to be sold on the world markets. Now, refining margins like diesel and jet fuel are going to rise due to costs in insurance and longer routes, as well as higher freights and insurance costs for oil shipments. So these are going to be the kind of trends that we are going to see, and the potential impact that we'll be seeing.
Yeah, and talk to us about what the rising Brent crude prices could mean for us locally here in Ghana.
Well, locally, if you check the statistics from the Ghana energy sector, you can see that about 70% of fuel and refined fuel supply that we use in the country actually comes from these imports. So these happening, there are going to be 2 main things that are largely going to happen in the Ghanaian economy. And the first one is going to be about the international price of gasoline and diesel price increases, which is directly going to affect our import bill. Secondly, is also going to be about the fact that these imports are priced in dollars, and any pressure on the exchange rate between exchanging the cedis for a dollar is going to amplify the effect that we are going to see in the country. And so in practical terms, a higher Brent price can lead to higher pump prices during the next pricing windows, because when these fuel prices increases, it is typically going to feed into the economy through transportation costs, food distribution, and electricity generation, especially in sectors where we use thermal power generations. And so in the short term, there is going to be a moderate upward pressure on fuel prices, which is going to be seen in higher transport fares and food prices, thereby affecting the overall cost of living in the long term of the ordinary Ghanaian.
Well, some stakeholders have said this situation should be a wake-up call for Ghana to prioritize energy security. What practical steps can the country take right now?
Yeah, absolutely, absolutely. This situation actually highlights the structural issue that we have when it comes to energy security in the Ghanaian economy. Having energy security also is not just about having the resources, but also having resilient supply chains. And so in the short term, since these ongoing tensions are still happening, the practical actions that the government should be taking into account should be strengthening fuel stock reserves. That is by maintaining sufficient reserve that is going to help cushion temporary disruptions that we are going to face due to the tensions that are happening in the Middle East. Secondly, the government can also focus on improving domestic refining capacity. Now we are where Tema Oil Refinery is refining some oil in the country. I think government should try as much as possible to pump in some investment to ensure that we are able to refine more oil on the large scale, and we'll be able to reduce the exposure of international refined products on the Ghanaian economy, especially in these times when there's a lot of volatility in the sector. The third thing is also for the government to focus on deepening regional energy cooperations, having various alliances with West African countries and the whole of African countries benefiting from their refining capacity. For instance, Nigeria has a lot of refineries in the country. Governments, through bilateral relations, can cooperate with them and try as much as possible to coordinate some procurement to reduce supply vulnerabilities that we may be experiencing. And if the government is able to put in place some of these strategic measures, then we would be able to reduce the risk that we will be facing here in the country.
Yeah, I mean, speak of risks, we are seeing the risks of dependency. We are told that Africa imports over 80% of our petroleum products from outside the continent, Ifeanyi.
Yes, which is, I mean, it's quite risky where to see that Africa imports a large portion of its petroleum products from outside the country. It's a very risky thing, especially during these geopolitical unrest and tensions here and there. So I think various governments around Africa should try as much as possible to ensure that the capacity when it comes to refining products should be increased, because that is the main problem. Even though we have the resources and everything, that is where our problem. We have limited refining capacity, which means a lot of the countries in the continent will have to export crude and then later have to import refined products. And once these refined products are coming into the continent, they become more expensive due to the fact that some value of salt has been added. So this creates the concept where we say it creates like a refining dependency. So during global crisis like this, price volatility, there's going to be a lot of price volatility in the economy due to our exposure to these international benchmarks. Secondly, there's going to be supply disruptions, especially when supply routes are affected. And foreign exchange products, as we normally see, is one of the most common effects that we see around in Africa. And so when geopolitical conflicts occur, these tensions we are currently seeing, the vulnerabilities becomes more, and then countries that depend heavily on these imported fuels often experience an inflationary pressure and also a fiscal strain. So dependency is not just going to be an energy issue, but it's going to also affect the macroeconomic stability of the entire continent. And this is a risky thing that governments around the continent should come together and find a solution to.
Okay, as we wrap up, so again, what policies or investments should Ghana consider to make us less vulnerable?
So I would suggest that Ghana should pursue a multi-layered energy resilience strategy. And this is going to include, first of all, revitalizing and modernizing our domestic refining capacity. It's very critical for the government to do that, establish more refineries around the country, and it shouldn't just be a few refineries around the country. Government, if possible, should enter into government-private partnerships, build more refineries around the country to ensure that we have more reliable supply of refined products in the country. Secondly, we should also try as much as possible to expand petroleum storage infrastructure. Expanding the infrastructure is going to mean that government is going to have certain oil products supply to cushion the people in the economy during these times of tension. And thirdly, we should try as much as possible to diversify our energy mix in the country, which is very, very important. We should look at the renewables. Government should try, there's a lot of sunshine in the country. Government should look at some of these areas, invest in renewable energy to power the energy sector. And lastly, try as much regional strengthening and cooperation with the regional heads, with the West African bloc and the entire African bloc. If government is able to come up with policies through some of these partnerships, then we would be able to rely on supply from other countries in the bloc of Africa. And Ghana is going to see less of the impact when some of these tensions happen around the world.
All right. Ifeanyi Osuajman, chartered energy economist, thank you for your perspective. You're watching The Marketplace. Now, turning to other news, a Court of Appeal judge, Richmond Osehre, has urged newly certified alternative dispute resolution practitioners to position themselves as strategic partners in strengthening Ghana's justice ecosystem. Speaking at the graduation ceremony of the Alternative Dispute Resolution, Security and Research Institute, he highlighted ADR as a critical mechanism for improving efficiency in dispute resolution and fostering a stable environment essential for business confidence and economic growth.
Your mental health is the backbone in the judicial system. So there is an opportunity to engage in the CCADR, the Court-Connected Alternative Dispute Resolution. They need trained people like you. So I urge you to assist us. You can register with the various courts so that whenever they need your services, they can call on you.
ADR has come to take over the work of lawyers can never be true. You understand? Because we have the ADR Act, which gives opportunity for people to have alternative resolutions. I think, and so I would advise that when people have issues, they look at the ADR concept first before they rush to court. Until now, a lot of people didn't know even maybe there's an alternative. We politicians, so yeah, I go to court. You understand? Going to court, I don't think solves all the problems. That's why when they say ADR, they say win-win, because in the end, everybody gets what they want, one way or the other. That there's a lower level of acrimony, and there's more peace.
All right, and that's it for The Marketplace. More news on our website, myjoyonline.com/business. We leave you with the latest international headlines.